HubSpot is up more than 1,500% since this company came public in 2014. But does the pioneer of inbound marketing deserve a spot in your portfolio? Here's all the key information that you need to know.
HubSpot is a $23 billion company that goes by the ticker symbol HUBS, H-U-B-S.
HubSpot's mission is to help millions of organizations grow better. Simple, optionable, I love it.
The company got its start by focusing on inbound marketing. It helps small and medium-sized businesses attract customers to their website via blog posts, videos, and podcasts. However, it has since expanded to include multiple hubs, including sales, service, content management. It is a fully fledged platform.
HubSpot deploys a software as a service business model. About 97% of the company's revenue comes from subscription sources, and it has about 3% of revenue coming from services.
Technically, this company has a freemium model where some of the tools are available for use without having to pay a subscription. However, the vast majority do require a subscription.
The company's dollar-based net revenue retention rate is over 110% recently. That's a very impressive number given that this company mostly caters to small and medium-sized businesses who tend to be higher churn customers.
Those customers, because there is churn and there are a lot of them, are expensive to acquire, meaning that customer acquisition costs are medium high for this company.
On the bright side, once you start using these tools, you tend to stick with them throughout the economic cycle, and the vast majority of this company's revenue is recurring in nature.
Now, when we look at the company's moat, I would argue that there's a weak network effect within organizations, but the first most important one are switching costs. That 110% net dollar retention is really high for a company that focuses on such small teams. Once these teams start using HubSpot, they would be loath to switch.
We also think that the company's brand name HubSpot has become synonymous with inbound marketing, which is essentially a category that it has created. For that reason, I would give this company credit for having a strong brand.
Because of these multiple moats, the fact that the company is acquiring new customers and is able to roll out new products to its existing customers, we believe the moat is widening for HubSpot. One of the key ways that you can see how this moat is widening is to look at the number of customers that are using more than one of the company's hubs. If you look back in 2017, you'll see that 2/3 of them were using just the marketing hub. But fast forward to the beginning of 2021, and over half are using 2 or more hubs. As a company adopts more hubs, the switching costs become even higher.
Turning to the company's financials, revenue growth here has been very good for many, many years. In the last 3 years, this company's top line has grown at a 37% compound annual growth rate.
Gross margins are just a hair below 80%, which would be the envy of most publicly traded companies.
That's all good, but the bottom line isn't as pretty, at least on a GAAP basis. On a GAAP basis, this company is not producing any profits.
However, when we look at free cash flow, which measures the amount of cash that's actually going in and coming out of the business, it has not only been positive over the last 3 years, but it's been increasing at a nice clip.
The company's balance sheet isn't perfect, but with $1.1 billion in cash and just over $750 million in debt, the company can easily survive any economic downturn.
And because the company has negative net income, its returns on capital are negative, but we don't expect that to stay that way for very long.
Let's switch gears and look at the management team. HubSpot was founded by Brian Halligan and Dharmesh Shah, both of whom are still at the company today. However, they are not in the corner office.
That corner office is now occupied by Yamini Rangan, who's been with HubSpot for 2 years and has been the CEO for a little less than a year. Before that, Halligan had been the company's CEO.
HubSpot does a phenomenal job at keeping and engaging its employees. The company gets stellar reviews on Glassdoor and has won numerous Best Places to Work awards.
And if we look at the company's latest proxy statement, we see that insiders own 6% of shares outstanding, which isn't super high, but it's also not bad, especially when you consider that that is worth $1.5 billion at today's price.
Turning to potential, HubSpot has clearly demonstrated that it has a lot of optionality in the platform. It started out as just a marketing hub and over time has added new products and services that have opened up new revenue opportunities for the business.
As we've already covered, because this company is not net income positive, it is still in the red. However, it is quickly approaching the break-even point, and we expect that once it does, net income will increase markedly.
Third parties believe that HubSpot's total addressable market opportunity is around $8.4 billion, of which the company has captured about 14%. It is worth noting that that $8.4 billion number is expected to grow rapidly over the next couple of years.
And what's truly impressive about the company's expansion into new hubs is that the vast majority of it has come without acquisitions. It is all organic.
HubSpot has been a phenomenal investment ever since it came public. This company has spanked the returns of the S&P 500 since its IPO'd and over the last 5 years.
The company also consistently outperforms analyst expectations, and over the past year, 4 out of 4 have come in ahead of the consensus.
At the same time, the company is not yet focused on capital return, so it's not paying a dividend, buying back shares, or paying down its debt.
Now, turning to risks, one of the key, if not the key risk to keep an eye on is competition. This is a highly competitive and lucrative market.
On the plus side, with hundreds of thousands of paying customers, there's almost no customer concentration risk for investors to be aware of.
Now, part of those really great reviews on Glassdoor probably have to do with employee compensation. HubSpot is not timid when it comes to granting stock-based compensation, which means that dilution has been fairly high.
On the plus side, we think that this company is fairly easy for investors to understand, and there are few outside forces that we could think of that would impact this business.
So what's the catch? Well, the main one is its valuation. This is an expensive stock, trading at nearly 30 times sales and over 150 times free cash flow.
So what are the key things for investors to watch moving forward? Number one is multi-tool customers. You want to see customers not only come in, but you want to see them upsell over time into more and more hubs.
Second, we want to watch those retention rates. It was a big deal when HubSpot was able to move its net retention rate from below 100% to above 110%. You should want to see it stay above 110%.
And finally, keep an eye on the bottom line. HubSpot has been in hyper-growth mode on its top line for many, many years, and its margin profile is great. Moving forward, we want to see those translate into net income and see outsized growth in profits for many years to come. So how did this company score on our investing checklist? It did extremely well on my checklist, getting a quality score of 84. That is well into my high-quality business category.
It did very well on mine as well, getting an 11.5, a half point short of that coveted anti-fragile territory. It makes me wonder, why don't I own this stock?
All right, Brian, both you and I think that this is a very investable idea, so we're going to head on over to stockcard.io to hold ourselves accountable. I'm going to open up the anti-fragile portfolio, which is your thumbs up portfolio. I'm going to enter the ticker symbol, which is HUBS for HubSpot. I'm going to do a buy decision. Today's date is Monday, January 10th. This is a $509 stock, so we're going to be buying 2 shares, and this scored 11.5 on your investing checklist. Then we're going to head on over to my portfolio, which is the Brian Feroldi quality checklist, and we're going to do the exact same thing.
While Brian does that, we want to remind all of our viewers that you can head on over to stockcard.io and register with the website. And when you do, you can enter the Beat the Brians contest. So far, we've got over 300 portfolios. The top scoring portfolio, the one with the greatest returns across 5 stock picks, will win a $1,000 prize at the end of the year, with smaller prizes spread out throughout the year. Join today, and it's a fun and educational experience.
We hope you found this video to be informative. Both Brian and I think that HubSpot is an interesting company with a very bright future ahead of it. Brian's out.